Good day, fellow investors. With the stock market at all-time highs, a hedge could be the best value investment out there. Yes, over the last 15 years, the stock market did great, and we all expect it to continue to do so. However, the last time we were in a tech bubble exuberance, for the next 10 years the stock market did terribly. So we don't know what will happen. And in that case, you want the upside, but you want to protect yourself on the downside. Because at the end it's about your wealth. Let's discuss a few scenarios. This is the one that everyone expects, 10-15% per year, as it has been the case for the last 10 years. However, this can also be the outcome based on the 2000s, let's say. So the key question is, can you accept option number B for your wealth over the next 10 years? If you don't want this, you hope for this, maybe it is better to settle, okay, I'm hedging myself, which carries a cost, so the returns all else equal, or I'm going for certainty. Certainty could also mean a range, but the key factor is that you are increasing your wealth with a high degree of certainty without risking losing 50% of your wealth. Therefore, a hedge might be a best value now so that you are guaranteed to reach your financial goals and your long-term wealth levels increase no matter what happens, what Trump does, what the Fed farts, or whatever. We've discussed the risks of the market in a recent video, and there were many questions. Okay, how to hedge this? What is the proper way? Diversification, exposure, correction. Nobody expects a crash. The worst thing that can happen with the market is a 10-15% correction, and then stocks go up again. However, let's discuss the why, whether we can predict what can happen, thus we can hedge on prediction, or it's better to be market agnostic, the value, which means the price compared to the benefit, then discuss various hedging options, and you'll get also my summary. Let's start with the why. Why would we hedge when nothing can stop this market? Stocks will keep going up 10-15% forever, and that's it, Sven. Thank you, goodbye. See you, you don't even have to make videos, there is no point in doing anything, let's go party. Well, if you look at the chart, it's very difficult to bet against this. However, if you look at Europe, it's also at all-time highs, but it's 25 years of nothing. China has seen exuberance a few times, maybe we are entering a new phase of exuberance. But all stocks globally are now pretty exuberant, and if I look at just the headlines on Bloomberg, it's all about Nvidia, Micron, doing well, everything, investments, data centers, AI, everything will be great, everybody's having a party, an AI party, and let's go. The key question is, can this end well? Now, this is an AI party, let's ask AI. And that's exactly what I have done. I have asked ChatGPT, can this end well? What happens? And then we have markets move in cycles. So we have seen just the pluses now, not the downside. Valuations, history tells us, do matter. Nobody's concerned about valuation. Psychology plays a big role. So now everyone is feeling great, thus pushing things higher. But when the narrative doesn't work anymore, then we need or a new narrative that has happened in 2022, or it goes down. It doesn't have to end in disaster, but AI says it rarely ends smoothly. So after the billions invested in AI, everyone is betting on AI, but nobody's listening on AI. There is a discrepancy there. It means that not everybody that joins the party makes money. So let's look at today's macro setup. Equities, valuations are stretched, to put it mildly. If we look at the current Shiller P ratio, it's 40. 40. This is a slide I've been using 5 years ago when the P ratio was around 30. Now we are at 40. And then it's very likely you will see good returns going forward the next 10 to 15 years. That's reality. Rates and liquidity, the Fed is already cutting, but jobs are no longer solid. Everyone is focused on the jobs economy, who cares? Credit spreads tight, risk takers are happy to get, 6% on high yield junk bonds, which is nothing compared to 4% on treasuries. Speculation is extreme. Just look at the Bitcoin up, 4x in the last 2 years. So AI is smart and humans will always be humans. To quote Albert here, two things are infinite, the universe and human stupidity. I'm not sure about the universe. So more from AI, euphoria always feels good until it doesn't. 1920s, 1990s, crowds can stay euphoric longer than expected. You don't want to bet against the market. The latecomers pay the bill. I hope for humanity this party never stops, because then it would look extremely ugly, as we are at levels far beyond the terrible 2009 Great Recession. And same here, the roaring 20s, you can pause, you can read if you want to just see the history, the nifty 50s, again, technology, everything, global, the dot-com bubble, the global financial crisis, that's all that has already happened. The Nasdaq fell 78% in 2 years. Can you imagine that? But now, yes, things are different, they are making profits. However, it's highly competitive. We don't know what will happen. Maybe the party will continue, maybe it will crash. That's impossible to know. But if you are hedged, you don't care. Because can we predict a crash? Again, asking AI smarter than we are. We can't predict. Markets are irrational, warning signs exist, but you cannot go exact and dating that. Catalysts are also unpredictable. Value investing response isn't prediction, it is preparation. How to prepare? You can think about hedging. If you are long all these financial everything bubble assets, the key is that your outcome range, investing range for your wealth is like this. Worst case scenario, I don't know, you do 6% per year. Best case scenario, you do 15% per year. Let's discuss this mathematically. S&P 500, if it just keeps on going for the next decade, will be at 17,000 points in 10 years. But if there is just one crash, one minor crash of 50%, somewhere at the beginning, your returns are practically 1% per year. That's a huge difference. Just one bad year, the rest is all 10, 10, 10, 10, 10, 10, 10, 10. So some say, Sven, but what about earnings growth? Earnings are growing, this or that. If we look at the S&P 500 P ratio, we look at current earnings, yes, if earnings grow at 10% per year over the next decade, then those will be at 568, and that will be a P ratio of 12 for the S&P 500 in 2035. However, a decade of growth is very, very unlikely. The average growth was a few percentage points over the years. Here again, the data points, 4% according to Guru Focus. Real growth is a little bit lower. Schiller, Wikipedia, 3.5, perhaps even 2.6 per year. Because everyone is investing AI. Factor in a little bit of competition. The Fed is cutting rates, but they are also saying that the job market is not very solid. Jobs, AI is not spending, people are spending, economy, investing, earnings, return on investments. It's always a cycle, it always will be. Let's go for 5% earnings at best, thanks to AI, thanks to profitability. Then we are already just at 357 in the next 10 years. That's still a P ratio of 18 in 2035. That's still higher than the average historical of 15, which means there is still a risk. So the party is going on, this is the situation, and exactly when nobody thinks about it, hedging could be cheap value. You want to think, okay, how much is it worth to protect my portfolio? Let's say this is one outcome, let's say this is the other outcome. The difference is 9 percentage points per year in compounding. That means that it's justifiable, perhaps, to protect from the downside to spend 9% per year, and then you are sure you will get to this worst case scenario. But if you can spend 4%, 5% or even less, then you can cost effectively make sure that your wealth is somewhere here. Perhaps even higher. If the market returns 15, you spend 4 on returns and you are sure of 11% with less risk. Let's check the cost protection for the S&P 500. And for that we can use put options, an option to sell an asset at an agreed price on or before a particular date, as said by another AI, not ChatGPT, this is Gemini or Google or whatever. And if I look at the S&P 500 option chain, I look to protect myself for a year, and then I look here, it costs what? 5.3% to absolutely protect yourself from any kind of downside of the S&P 500. So if the market keeps on doing 10%, you protect yourself with 5%, you are sure of a 5% return, while the upside can be even 15% if the market goes higher. If you're willing to take, let's say, lower protection rate, you're willing to lose 10% from the current and then only be protected, then it just costs 3.2%. If the market just keeps going up, you are at a 7% return. The goal here is to be sure that your returns are better. Cost-effective hedging would be that the market does this and you are sure you will end up higher. That's cost-effective hedging, so that's a different story. We'll discuss that a little bit more and then you can dig deeper. So, is it worth to spend that protection? You have to make your calculation. But when it comes to hedging costs, the lower the volatility, and we are relatively low compared to Liberation Day peaks, pandemic, crisis, euro crisis, then you see that now is the time to think about it. Because if we look at that put option for the year, the price, what is this, tripled 3x during Liberation Day month, April, because people were panicking. When people panic, it is too late to buy insurance. Now is the time to think about it. By the way, if you want to check my portfolios, my way of hedging, 21-day money-back guarantee, see if value investing for the next 10 years might be your best hedge, check my research platform. Here are the videos or in the link in the description below. Also, the videos are there explaining what I do. Think about it. How are you exposed to risks, whether you can tolerate risks, and whether you will sleep well. Learn about it, use Gemini, use whatever, how to protect this and this portfolio, go for it, ask ChatGPT or something, and they will give you a clear answer on what and how you have to do it, what are the costs, what are the benefits, and make a calculation just to see whether you can adjust that risk and reward in the current environment. Then there have been other alternatives, other ways of hedging. So Christian here asks about how to hedge his $10,000 portfolio. The option costs $2,000. The option contracts are usually 100 contracts. So one contract, you need to have a little bit, let's say, more exposure. Should have 100 S&P 500 SPY stocks, that's 60,000, and then that is 5% to hedge. However, if you just have $10,000, let me be blunt here, the best way to hedge is to maximize your income, maximize your saving rate, maximize your earning potential, protect your earning potential from the AI disruption that is coming. Don't waste your time on stock market investments. It can be educational, that's right, but with 10,000, don't think about hedging, think about making. And then, okay, build, learn a little bit, but really focus on making money. First, invest, see the 10,000 and investment in knowledge so that when you have more, you know what to do. So here it is, you need a 66K portfolio, then you can buy 2,000 of options, and that's the 5% hedge. Other hedging options, here there was a great comment, you can buy put strikes out, things like that. And I had a friend when I was working in Bloomberg in London, he was making I think 36% a year on option trading. The issues are, it was his full-time job, and whenever he would try to place a bet that was more than $20,000, the high-frequency traders would see it and then just beat out the profits out of that. So it's very liquid, as also here said. It is practically a full-time job. You need to be there. That's a different story. Then we have treasuries, tips. Tips just protect you from inflation, that is the yield plus inflation. It can also go negative, can be positive, but it's not a way to create value. It's just a way to do practically nothing and be sure that you don't lose much and you don't get anything. Then there was, okay, are there any common ways to hedge a 10K portfolio, ETF, reverse, or something like that? Then I went to Investopedia and they have a great title, Cost-Effective Hedging. We have discussed cost-effective hedging with Mark Spitznagel in a few videos, Be Hedged also, so I'll put the link to these in the description below for those who want to dig deeper. But cost-effective hedging means that you are going to reach a higher return with a higher degree of certainty, which is certainly not what Investopedia is discussing, because they discuss using ETFs like the ProShares short, and then if the market goes down, you should make money. Well, these vehicles are all daily vehicles, so those are made to go to zero. When something is daily, it protects you just daily. When the things have to adjust over the next day, then there is a loss. There is a daily reset. Again, pause this, read it, and you'll see how you lose over time. Keyword daily, so it's not for long term. There is the key loss standard, volatility decay, beta slippage, and things like that. So the inverse daily ETF will almost always be down because of the choppiness of returns. It can also happen that the stock market crashes 20%, but if it goes up and down, you might not see any kind of hedges. Trading costs, management fees, whatever, you are guaranteed to lose long term, whatever actually happens. This is not a cost-effective hedge. I checked a little bit the article, they didn't mention it, so it must be somewhere in the disclaimer that it's a wrong article. I'm sorry. My way of hedging, I like to own businesses. I make my 15% a year, whatever, and that's how I'm hedged, whatever happens next. That's my strategy. Good fundamentals, good growth, good market positions, defensive, whatever happens, I'll keep on compounding my businesses, and that's my best hedge. To summarize, hedging is a cost. Maybe you can be genius enough to make it cost effective so that you make even more, but I think for most people, just protection should be enough. So I've received an email and the client said, I'm losing 100,000 on my 3 million portfolio. Okay, and I will just renew everything, but I'm protected on the downside while I am enjoying 20% up for the stock market in the last few months. That's how it works. ETFs are a sure loss. The goal is that you reach a higher level no matter what happens. The key is to compound over time and see how it fits you. This was a great comment here. I do like the you do you, I'll be me, here's what I'm doing, good luck to everyone mentality. It's easy now that we have been enjoying 15 years of great returns, but this is what makes the difference in wealth accumulation. How you navigate this. History tells me that this will happen again. I hope never, but who am I here to bet? I don't want to bet that there is downside, the market correction. These people never seen a huge crash, and that is where the pain is. I hope it doesn't happen, but I don't want to care whether it happens or not. I want to do well whatever happens. If you have any questions, Here is my email, investwithsven@gmail.com. Also, check my videos showing what I do. Our quadrant, value investing, is how we plan to compound our wealth over time.